Leaderboards are fun, but the real edge in AI shows up where money meets firms and then actually diffuses through the economy. So today we zoom in on three levers. So who's funding the build out, which companies have the R&D muscle to turn compute into products, and where AI is genuinely being adopted at scale. The note we're using argues that these are the clearest signals of durable advantage across advanced economies, and this Fed note is cited in the description. You can read it yourself. Please do, and let me know what your big takeaways are. With that being said, think of this as kind of like a pipeline in a way, where you start where capital fills the tank from private investment, especially like venture funding, which kind of determines how fast and which ideas get resourced. Secondly, firms convert that capital into capability through R&D. And then thirdly, adoption spreads capability into productivity. So people actually have to adopt the new tech in order to use it and be productive. So country level uptake is messy to measure, but a mix of national statistics and skills-based indicators show which economies are actually putting AI to work. Across all three, the U.S. stands out as in funding more, spending more on firm-level R&D, and showing broader diffusion, while the rest of the advanced economy pack faces frictions that slow translation from labs to the real economy. So money's kind of like a decade-long gap for AI. So from 2013 to 2024, cumulative private AI investment in the U.S. topped at $470 billion, and the comparable totals are roughly $50 billion across the EU, $28 billion in the UK, $15 billion in Canada, and $6 billion in Japan. So the US also tracks the majority of global VC for AI-related data startups and over 75% of reported funding in generative AI ventures. That capital depth funds infrastructure, research, and the messy productization work between demos and the actual deployment. So where this R&D kind of actually counts. So firm level R&D intensity is highest among US companies in both ICT hardware and software. The EU sits a bit behind in hardware and far behind in software despite solid growth. And then Chinese firms have scaled hardware R&D but reduced software intensity, both still well below US levels. That matches OECD evidence that a larger share of U.S. firms conduct AI-specific R&D for commercial use than their peers. It's kind of a translation, so more firms in the U.S. are doing the day-in, day-out engineering that pushes AI into products. So beware of averages and then kind of look at the skills. So cross-country adoption stats are tricky. Surveys often heavy on large AI-intensive firms report much higher usage than national statistics, which include more SMEs, as in subject matter experts. Unsurprisingly, the U.S. ranks highest in many survey snapshots, but definitions differ for what this means across surveys. For example, the U.S. BTO survey tracks use in the past 2 weeks, while the Eurostat reports these annually with less intensity and detail. So importantly, employment-weighted methods raise estimated U.S. adoption, suggesting firm-level responses can understate diffusion of the actual AI products. So if we shift from firm self-reports to skills-based indicators, the U.S. picture strengthens. So alternative diffusion measures show the U.S. largely outpacing other advanced economies. Only France really surpasses the U.S. in transitions from non-AI to AI jobs, kind of like a proxy for upskilling, like actually learning new skills and improving. And then the U.S. far outpaces peers in embedding AI into manufacturing processes. So plus stronger signals in education, financial, and technology services. These are the places where AI becomes productivity, not just kind of the press releases themselves and just kind of, being overkill. But where does this adoption stall? So some frictions are structural. So like high electricity prices, notably in parts of Europe, are associated with lower AI use among firms, especially large enterprises. At the same time, the AI build-out itself raises electricity demand, nudging prices higher. The note also hints that European progress on deepening the internal market and advancing a savings and investment union could help relive relieve capital and diffusion constraints over time. Bottom line of this note, put together the analysis. The analysis concludes that the U.S. largely outperforms other advanced economies across key areas of AI capacity, and then China remains competitive in some domains, but its largest advantage in energy infrastructure. But the combination of robust compute and sophisticated investment climate and emphasis on diffusion positions the U.S. to capture more of AI's future gains. Gaps in one or more of these pillars are likely to limit the near-term gains for these AFEs, as in AFEs meaning advanced foreign economies. So in conclusion, the AI edge shows where ample funding meets high R&D intensity and then spreads via workforce skills and real-world use. But by those measures, the U.S. has a durable lead, and unless capital access, energy costs, and diffusion bottlenecks ease, many advanced peers will struggle to close it. That doesn't mean they can't. It just means the fastest path is to target the pipeline, lower frictions for investment, support firm-level R&D, especially in software, and focus on skills development where the productivity payoff is clearest.